Welcome back to another episode. In this video, I will be showing you how to use the head and shoulders pattern. There's also a free platform where we demonstrate how to use these strategies in real-time markets. Make sure to hit the like button and turn on your notifications so you'll never miss any of our uploads. So, what is the head and shoulders pattern? It is a price pattern that forms containing traits of both the bullish trend as well as the bearish trend put together. This lower high on the left is the left shoulder, this higher high is known as a head, and this lower high on the right is the right shoulder. This price pattern forms at the end of a bullish trend and signals a possible trend change. This is how it works. The left shoulder and the head represent a bullish trend because price broke above this high, forming a new higher high. And for this bullish trend to continue, price has to form a higher low and a new higher high closing above the head. So this equal low and the lower high show you price has lost its strength and can possibly reverse. To confirm the trend change, you draw a neckline from these lows, and if price closes below, creating a lower low, the pattern is complete. With the lower high and the lower low, you have a confirmed moving downtrend. In the opposite direction, the inverse of the pattern works the same way. This is the left shoulder, the head, and the right shoulder on the right. On these highs, we have a resistance also known as the neckline. Again, the movement on this side indicates a move down, so you'll only be interested in selling until a higher low forms. That's when you'll think to yourself, a higher low in a downtrend indicates a possible trend change, so I must close all short positions and prepare myself for a new uptrend. Once you have a new higher high, the pattern is complete, confirming the trend change hinted by the higher low. In this section, I will show you the 5 best ways to use the head and shoulders pattern. To show your support, please give this video a thumbs up, as it lets us know you want more videos. Here is how the neckline break entry looks like, now on the charts. In an uptrend, you'll mark your highs, taking pullback trades, trading with the trend. If a trade reverses before creating a new higher high, it indicates the bullish trend is exhausted. Seeing a possible trend change coming, you mark the left shoulder, the head, and the right shoulder. This will be the neckline. The break below the neckline confirms the pattern, and as you now have a moving downtrend, on the close below, you enter short. This is the same setup as the one we broke down in the Fibonacci video. We're using the trend lines and the fib level provided an entry point down here. Using this strategy, after the lower low formation, you would mark this as the left shoulder, this is the head, and the right shoulder on this lower high. These lows give us the neckline. Once price closes below the neckline, the trend change is confirmed, giving you an entry point up here. Now, this doesn't mean using trend lines or the Fibonacci is invalid. This is just to show how to incorporate different strategies to increase trade probability. You can use the head and shoulders as confluence for the trades you take on the trend line, or use the trend line trades as re-entry positions to add to the winning trades you took up here. This is the gold price on the 6-hour time frame. Starting from this high, a series of lower highs and lows formed, indicating a moving downtrend. On this push to create a lower low, sellers couldn't pass the zone formed by this low, giving us the right shoulder. The 2 reversals give us the neckline. A break above the neckline with a new higher high would have been enough to give the entry long, but in this case, price formed 1 candle breaking above 3 key resistance levels, which is a good confirmation for entries long. However, the candle closed way too high above the neckline to be used as an entry point. In cases like this, you must use the second entry point using the head and shoulders pattern. Here is the anatomy of the pullback entry point, now on the charts. Since this is already a confirmed moving uptrend, you only need 2 things on the pullback to enter a continuation trade. When price reaches a level, you wait and see if you get rejection candles showing sellers are losing steam. Once you have that, you look for signs of momentum gain showing new buyers have entered at the key level to push price further upward. This setup is quite similar to the previously discussed setup, except this had an imperfect inverse head and shoulder. For reference, this is a pound-dollar currency pair on the 4-hour time frame. Price formed the inverse head and shoulders and a double bottom as the right shoulder. This imperfection doesn't invalidate the pattern protocol, as you still have the higher low as indication, and if you get the higher high, the pattern is complete. Entry 1 is at the close above the neckline, and if you're more conservative, you'll wait for the pullback entry. When price reaches a level, you add multiple long wick candles indicating rejection, and after the bullish engulfing candle closed above forming a new higher high, the trend change is confirmed. Now let's move on to how to use the head and shoulders pattern as confirmation for entries you find at a key level. This is a rough representation of what you'll look for. Jumping back to the charts. The reversals down give us a key level. Returning to the level, a long wick candle, color change, an inside bar formed rejecting resistance. This pattern combination indicates buyers couldn't pass the resistance, meaning sellers held strong at the level. So you'll look to short, aligning with the bearish presence active at the level. To confirm this, price formed a bearish momentum candle, but it was too low to be used as an entry point. Knowing how to find a trend change using the head and shoulders, you identify the left shoulder, the head, and the right shoulder. These key points give you a very valid neckline. This candle closing below the neckline confirms a shift. And as you now have a moving downtrend, you can take your entry short on the break or wait for the pullback trade on the neckline. The two lower lows give us a key zone. The two reversals bouncing off the zone give us a double bottom. The high holds the neckline. The close above with the bullish momentum candle confirms the double bottom. This low, together with the one on the other side of the double bottom, creates the shoulders, making the double viewed as the head. Another neckline is found on these highs. The close above the neckline completes the inverse head and shoulders. How many more entry points can you spot in this chart? As a member of this channel, you should be able to spot at least 5 re-entry points following the entry on the bullish engulfing candle. Tell us in the comments section how many you can find. One more thing, be sure to turn on the notification bell so you get notified when we upload a new video. Moving on to the right shoulder early entry. These reversals up show you that when price is above this level, buyers take control and push price higher. So when price closes above the level, creating a new higher high, you'll look for the same pattern to repeat itself. Looking for more confluences to support the trade long, you realize this is the inverse head and shoulders pattern, which is a reversal pattern. Although it works great as confluence, the traditional entry point comes after the neckline, which is a late entry in this case, because you want to trade the replication of this pattern. Here's where the right shoulder early entry comes into play. This move down and the pullback create a technical key support level, which means an entry on the right shoulder can still be deemed valid if price forms the correct reversal indications on the creation of the right shoulder. Note that without valid confluences similar to these ones, this trade with the right shoulder early entry remains an immature trade entry point. This high gives us key resistance. Consolidating after reaching resistance, the head and shoulders formed, rejecting resistance. Not willing to wait for the neckline break, you draw the technical resistance level originating on the left shoulder. To validate, you use the technical resistance from the previous head and shoulders visible on the downtrend. With the resistance now validated, you take your entry short on the close of the bearish engulfing candle, confirming the gain of bearish momentum. With the leverage from your now winning trades, you draw the neckline for re-entry points on the pullback. When price reached a level, multiple long wick candles formed rejecting resistance. To confirm the trend continuation, you draw a trend line underneath the pullback, and once price closes below, the pullback retest of the neckline is complete. So the fifth entry point using this pattern involves using multiple time frames to find a trend change, so you can get in earlier before the momentum candle moves away from a key level. But since it is the easiest to master once you understand the right shoulder early entry, we'll leave you to it. If you have questions, use the comment section below, and we'll get back to you as soon as we receive your comment. That's it for this episode. If you found value in this video, give us a like, subscribe, and I'll see you on the other side.